Hey everyone, hopefully you're having a good day. My name's Andy, my channel's Finding Value. If you guys are looking for undervalued investment opportunities, you came to the right place. Click subscribe. And today I'm going to go over ratio analysis. And ratio analysis, what does it tell us? It tells us what asset is cheap. And right now what we're doing is we are looking for the undervalued assets. I'm going to show you that commodities are the most undervalued asset that there is at this time. And then we're going to sift through some of the commodities to see which commodities are the cheapest and best opportunities for investment. So here's the ratio analysis presentation. Scroll down. Ratio analysis. So let's take a look at the big picture ratio analysis here. Let's find value and stores of wealth for the next decade. And that's kind of my time horizon. It could even be longer than that. And I'm looking for very large returns. Again, this is financial education only. You guys are going to have to do your own due diligence. You're going to have to do your own research to make sure that this stuff is right for you. But I think what it's going to do is point you in the right direction. So here's chart one. This is 100 years of commodity valuation. This is the commodity index to Dow Jones ratio. This is 100 years roughly. And where that star is where the valuation is today. It is the cheapest it's ever been in relationship to history. And what that means is that commodities are not just radically undervalued, they've never been this far in terms of undervaluation, ever. And it's an opportunity. It's an opportunity to make very good money. Very good money. So let's look at some of these ratios. This is the gold to copper ratio from 1990 to present. You can see that the average is kind of around, I'd say like 350, somewhere in here. That's kind of an average. An overvaluation state would be below 200, and in a very acute undervalued state is over 600. So undervalued for copper is over 600. Overvalued is definitely 200-ish. So when we look at this and look at it real time, this is a gold to copper ratio that I got from stock charts that I created. You can see that we were kind of in this uptrend here after 2007. We were moving on up, which means that copper was getting cheap in relationship to gold. We hit a top of 750, which is kind of a double top here. One top came across, two top, and now we're coming back down and we're around the 400-ish range, 448. We're trying to break below this bottom trend line, uptrend line. We are meeting some resistance, but it looks like we broke out. We're back testing, and I bet you this thing's going to come back down at some point. So copper looks like a good opportunity. Here's the platinum to gold ratio. The platinum to gold ratio right today is where that star is at. It's never been this cheap. So platinum is never been this cheap in relationship to gold for many years, since 1971, and since we started freely trading against each other. So platinum is an opportunity for investment. I'm going to go to a real-time chart here. Here's real time. This is from 07 to 2021. We've got the downtrend line, and what it does is it breaks the downtrend line, and then usually what it does is it goes sideways or back tests, and we're back testing is what we're doing. We're in the process of back testing, and these charts, remember, these are on a weekly basis, and they take time. These things don't change overnight. These are things that change over a decade or even longer. So we're in this downtrend line. We broke it to the upside. It means that platinum is starting to outperform gold. This platinum outperformance signals that inflation is most likely coming. Platinum usually outperforms gold, and it's an inflationary period. And the spot to be during this would be platinum because it's cheap and it's going to outperform, and we just broke the downtrend. Now here's platinum to palladium, usually in an inflationary period where you have economic growth and inflation and a commodity boom. Platinum will outperform palladium, and that's what we're seeing. We're just starting to see platinum outperform palladium. It broke its downtrend. It did a back test, and I think eventually platinum's going to outperform palladium. So we're seeing platinum outperform palladium. We're seeing platinum outperform gold. Usually that's inflationary, and commodities during this time frame usually outperform. So we want to look at commodities something like an oil. So here's oil. This is the oil to gold ratio on a very long-term perspective, 1861 to 2019. And you can see anything about 30 is super cheap for oil. Anything above it is radically inexpensive for oil. So we've got a very cheap oil price, especially when it went negative. That was an anomaly in history. So oil is very cheap. So if we go here and we look at the current oil to gold ratio, gold to oil ratio, we're coming up in this channel. We're at the bottom portion of the channel. We're at 29.52. I'm expecting this to break to the downside. This is a very cheap valuation. I think oil is a very good sector for investment. And I'm looking for that bottom channel to break to the downside eventually in a commodity boom. Why do I say that? Because here's the price of oil. We've got this long-term price going back to 70s. We've been in this upward channel, and we went all the way to the bottom side of this channel, even off the bottom side here for COVID. COVID came back up, and we're trying to break this downtrend line. I think if we break this downtrend line, we'll see a very big move to the upside. And I think oil eventually, I don't know when exactly, will be many hundreds of dollars per barrel at some point. So that's what we're looking at from a price perspective, is this break of the downtrend line, which I think is happening as I speak. Then we've got a gold to silver ratio. The gold to silver ratio, when it's high like this, is cheap for silver. I was buying the living heck out of it in this area up here. I know the premiums went kind of large in March, and they've kind of stayed pretty high for the premiums. But I've been buying basically anything over 80. I was buying in mass just all through here. We are all the way down, testing this uptrend line. And if we break to the downside of this, which I expect to happen, because we're in a commodity bull market that's going to be coming up, we could see a vast outperformance of silver in relationship to gold. And silver would be an excellent investment opportunity because it's going to outperform many other asset classes. So silver is going to be able to buy more gold, more more stocks, more other assets, more real estate, more whatever else you want to put in there. Those are the opportunities that I like to look after. So I think silver is a very good opportunity for investment. And here's the real estate to gold ratio. I know some people, they say that that this ratio is not a good ratio to measure gold or actually to measure real estate, I should say. Now, gold is just an accounting measure of how much money is in the system. So really what you're doing is you're stripping away the dollar price. People are looking at the dollar price and saying that real estate's up a whole bunch. And while the real estate market is going up, and it is up a lot in terms of a percentage basis, everything else is going up around it at faster clips, which means that it is losing value in relationship to other assets. And given the market conditions, given that interest rates have been lowered and lowered and lowered and lowered, I think we've hit bottom. I think interest rates are going to go higher. And with the interest rates going higher, I think real estate is going to outperform. And I know people think that that's backwards. Interest rates do not increase the price of real estate. They chase real estate and inflation. Interest rates chase inflation, and inflation comes from real estate. Real estate's going to go higher because we have a shortage in real estate. And real estate going higher is going to increase inflation. The increased inflation is going to increase interest rates because it's going to put a real negative interest rate on bonds, and then people will sell bonds, increasing interest rates. That increasing of interest rate is going to have an effect on stocks and their PE ratios. So in an increasing interest rate environment, real estate does well, gold does well, commodities do very well, and stocks and bonds do not do very well in an increasing interest rate environment. So all these assets are going to get repriced against each other differently in the future because of the market dynamics in the market conditions. Ooh, that was a mouthful there. So here's another way to look at it for the gold versus CaseShiller home price index. Gold has obviously outperformed real estate quite substantially on a percentage basis. So the one thing, there's also one thing else I want to touch on. On a 30-year fixed rate mortgage, if you have a very low interest rate, and we know that inflation could potentially be coming, and remember, we haven't had a long-term deflation. You can't have that. It is impossible to have a long-term deflation. And if someone says that you can, I'd like to see how that would eventually work, because then states and governments and all this stuff would go bankrupt. They can't service the debt. You have to have a growing inflationary environment of debt for the debt money system to exist. It doesn't exist in a big deflation. So any type of deflation is going to have to be short-lived. Otherwise, your currency fails, period. If we're going to have more and more inflation, and that's what we've seen in history, we've always had inflation, a 30-year fixed rate mortgage at all-time low interest rates is probably one of the smartest things to do. Is you lock in that low interest rate and you let inflation erode the value of that mortgage away. It's a sure bet. It's about as sure of a bet as you can get. Where if you have an inflation rate that is higher than your interest rate on your mortgage, you are paying back less paper dollar net present value calculation on the mortgage. So if you take out a loan of $300,000, you may pay it back with $200,000 of real net present value calculation if the inflation rate is greater than the interest rate. Hopefully that makes sense. And I've gone over that before in other clips. So of all of the opportunities, which ones entice me the most? Now, I didn't go over uranium here. That is a little bit different, but uranium is one of my top picks. Oil is one of my top picks. I like silver and I like platinum. I went over all the ones that I really, really like. They are extremely cheap in relationship to history on a ratio basis. And ratios tell us that value. They tell us relative value. So if you look at this, and if you can play this right, this is the viewpoint that I have, so you guys can kind of see my paradigm here. We know that stocks are expensive. We know that commodities are at 100-year lows. We are at 0.05. They need to increase probably between 60 and 100 times in relationship. Commodities need to increase at a rate 60 to 100 times against stocks. The stocks can go down, but commodities have to go up. They have to meet somewhere where commodities are going to vastly outperform stocks. Now, if we have the most undervalued, sought after commodities in this undervaluation group, the sector, so we're nitpicking in the sector what the best opportunities are. There are opportunities here where platinum could outperform substantially. And I don't want to say that the outperformance is going to happen, but what I'm going to tell you is a possibility that it could happen. It's a possibility. It's not an outcome. This isn't a prediction, but platinum could go to $45,000 an ounce and be within historical norms. We could have silver go to $1,000 an ounce and be within historical norms when gold goes higher. So if gold goes to 10,000 and we go to a 1 to 10 relationship where silver goes to $1,000 an ounce, it's within historical norms. Now, I'm not saying it's going to go there. I'm not saying it's going to, that's not my price prediction. What I'm saying is it's within historical norms. Same with uranium. Uranium could go up 20x from where it's at today and be within historical norms. So these valuations are jacked up to the downside. Everyone is viewing this world in this environment where interest rates are so low. What I'm saying is, and I'm not saying how high interest rates are going to go, but the trends are changing, and then interest rates could go higher, changing the dynamics of the market. With those interest rates going higher and the dynamics changing in the market, money is going to rotate from certain investment areas into other assets and investments. That rotation of money is what I'm looking for. And that rotation is just started, where money is going to rotate out of stocks and technology companies into commodities eventually. It doesn't mean that this year is the year. It looks like it's been starting. We are coming up on commodities. The ratios are changing. We're seeing that. So we need to be patient. We need to accumulate cost average in. That's what I'm doing into commodities and commodity type mining companies, and slowly accumulating all these assets for the long, big move coming up in front of us. And the reason I think the move is coming is because real estate is changing the dynamics of the markets, which is going to rotate the money. That's the way I view it. If you guys disagree, if you have questions, please leave comments below. Love to hear your opinions. And thank you for listening. This is Finding Value.